Okay, who likes paying taxes? I have a feeling pretty much everybody would say no on that. But what I'm finding is there's a way to avoid paying taxes that many people are not taking advantage of. And I think the big reason is they're just not doing any planning or they don't know about it. And what I'm talking about here is avoiding capital gains tax. What is a capital gain? So there's so many types of tax out there. When you hear the income tax, that really comprises thousands of different kinds of taxes. But a capital gain is it basically any kind of gain you have for capital or money you invested. So you buy something, it appreciates in value. When you sell it, Uncle Sam wants a cut of that gain. So for instance, let's say you were lucky enough back in 2002 and you bought $10,000 worth of Apple stock. Okay, it was $14.38 a share. Well, today, on September 6th, 2017, it's worth $162.71 per share. So today, that $10,000 is worth $113,150. So you have a capital gain, which is $113,150 minus your original $10,000. So you have a gain of $103,150. Not too bad. So, if you just went out and you sold this, you're going to be paying capital gains on it. But there is a way that you might be able to avoid that capital gains tax. What most people don't realize is if you're in the 10% tax bracket or 15% tax bracket, all of your long-term capital gains avoid any taxation. So basically, this chart shows you what you have in capital gains tax if you have a short-term or a long-term capital gain. So a short-term is any gain where you held the asset less than a year. So long-term is holding an asset for 1 year and a day. So if you bought Apple in 2002, you've got a very long-term capital gain. You got 15 years in. Had you bought Apple the beginning of 2017 and you sold it today, that's a short-term rate. So you can see here the 10 to 15% tax bracket for long-term gains is 0%. Even from 25 through 35% tax bracket, a capital gain really for long-term is only a 15% tax. And then if you're in the very highest tax bracket, which is 39.6%, you have a 20% capital gains for a long-term rate. Now you'll notice here for short-term rates, basically if you have a short-term capital gain, whatever tax bracket you're in, that's the tax you're going to be paying on that short-term capital gain. So obviously the government wants you to be a long-term investor, at least a year and a day. So again, 10, 15% tax bracket, you pay nothing on long-term capital gains. So what does that mean, really, when you're looking at doing a tax return? So here is a tax rate schedule for single folks, married filing separate, and head of household. So let's just focus on married filing jointly, since that seems to be what a lot of people are, a lot of taxpayers. The 10% tax bracket basically ends at $18,650 of income, taxable income. So we'll get into that in a second, what taxable income means. The 15% bracket taps out at $75,900. Now, if you're single, married, filing separate, we're talking $9,325 or $37,950. And head of household is a little bit different. But we'll focus just on married filing joint because that's what I'm focused on this demo. So essentially, you can have $75,900 of taxable income and you won't pay any capital gains tax. So let's dig deeper into this. Now, where this strategy is really important is for retirees. So when you first retire, you may go from a situation where you were a W-2 employee making hopefully good wages. And now that's gone. Now you may replace that with Social Security, you might have a pension, but your income generally is going to fall. Unless you're pulling a lot of money from a tax deferred account like a 401k or IRA or your 403b, or if you have a lot in pension and Social Security income. So you can control a lot of this when you first retire, and that's why it's really a strong strategy for a recent retiree. Before you hit the required minimum distribution at age 70 and a half, you really have total control over your tax return because you don't have the wages coming in. So you can kind of control if you're taking money from your IRA, if you started to take Social Security. Yeah, sometimes even when you take a pension or when you don't. So we can start to look at that and start the plan to help you avoid any kind of capital gains tax. So here is the situation. We're going to assume they're retired. So we have zero for wages. We have a nominal amount for interest and dividends. We'll say, for this example, I'm looking at $1,250. This person's lucky enough to have a pension, so we'll throw, let's say, $22,000 in for a pension, and they have started taking Social Security. Again, we'll throw out a nominal amount of $24,500. So their total income, adjusted gross income for the year, is $47,750. Now the thing is, this still isn't getting them anywhere near the top of the tax bracket. And remember, we're talking for tax brackets, taxable income. So right now that $47,750 is an adjusted gross income. We still get to deduct either your itemized deductions or your standard deduction. In this case, I'm going to just say they're taking a standard deduction of $12,600. And then you get exemptions, one for each member of the household. So here we have a married filing joint retired couple, so we'll say husband and wife. So you get $4,100 per person, or $8,200 total. So the taxable income for this couple is only $26,950. Remember, the top of the 15% tax bracket is $75,900. Now this couple has only used $26,950 of that $75,900. This means that they could take $48,950 of capital gains and not pay a single penny of tax on that gain. You can get close to $49,000 of gains and not pay a penny of tax on it. Think about that for a second. You can start to see, if you really do some planning, you can start to save some serious tax dollars. Again, I usually find this is best for somebody who's recently retired because you control where your money's coming in from a tax standpoint. It also works if you happen to have incomes in the 10 or 15% bracket. So if you, again, going back to our example on Apple, if you had purchased Apple 15 years ago and you have a large capital gain, $103,000 of capital gains on this thing, if you're in the 15% bracket or below, you can, over the next 3 years, you could set it up so you could take a portion up to that $48,950 of gains every single year and not pay a penny of tax. So really the first 2 years are the most important. At that point, you're looking at about $98,000 of gains that you take in the first 2 years. Last year, you're only looking at, $5,000-6,000 of gains. So really, if you planned it out, let's say you retired in 2017, you had bought Apple back in 2002. So rather than starting your Social Security, or rather than pulling from your IRAs or 401ks or 403bs, in order to stop building up your taxable income using those things, what you do is you use your capital gains and you can avoid taxes. Imagine that. Imagine making over 10 times your money on a stock like Apple and then not paying any gains on it. So this is a very powerful strategy for anyone in the 15% bracket. And again, retirees, please take note of this, because you are more than likely going to go in the lower bracket if you plan correctly. The key is you must do planning. So we look at the mistakes here, and you'll notice the second thing I put on there is not doing tax planning when you first retire. So many people retire, if they have a pension, and they just start taking Social Security right away. If you do that, you might use up most of your 15% tax bracket just with those two items. And then they've got these big retirement plans, a 401k or IRA, so they just start pulling the excess that they need for their spending from that. Don't do it. If you have other capital gains, we want to look at maybe liquidating those capital gains first to avoid taxes. The other thing that people make a mistake on is the first point here, taking too much capital gains that bump you into the next tax bracket. I actually did a return for a client. They sold a property and made a lot of money on it. They made $400,000 on the property. They bought it for something like $40,000 and sold it for $440,000, and it was 20 years later. Well, their income, if you take their Social Security and the pension that they had, they were still in the 15% tax bracket. So they assumed, because they were in the 15% bracket, that all their capital gains would be free from capital gains tax. Excuse me. Unfortunately, what they didn't realize was the capital gains affects your taxable income. So if you take too much capital gains, you could end up being bumped into the 25% tax bracket. And at that point, a good portion of your capital gains, you're going to end up paying tax on it. So you have to do tax planning. You have to plan this out. This isn't something you can just willy-nilly do. So another big thing to do, if you do have that Apple stock or some other capital gains, and again, this is outside of an IRA, this is outside of a 401k, this is just stocks, bonds, real estate, things you purchased outside of a tax-deferred account. So if you do have those, you may want to delay taking Social Security, and we start to take some of those capital gains first. That way you can ensure that you have plenty of room in that 15% bracket. We can use up as much of that $75,000 of taxable income in the 15% bracket for your capital gain to avoid taxes. Another area that this is enormously important is if you have what's called a net unrealized appreciation. This is really only for people who have company stock in their 401k. So if you don't have company stock in your 401k, don't worry about this last part. The NUA, or net unrealized appreciation, does not apply to you. But basically what net unrealized appreciation means is if you have company stock in your 401k plan, and let's say it's grown, you own, we'll use Apple as an example again. Let's say you work for Apple and you purchased Apple for $10,000 within your 401k. So that's your cost basis. But yet it's grown to be $113,000 over the past 15 years. So you can pull that $113,000 out of your 401k and you only pay tax on the basis, which in this case would be $10,000. So you're going to have $10,000 of taxable income in the first year. But going forward, from that point forward, if you take the gain on your Apple stock, now that it is out of your 401k, you're only going to pay capital gains rate. And if you're able to manage your taxes so that you stay in the 15% tax bracket, you're not going to pay any taxes at all on the Apple gain. So with some good prior planning, you can save a boatload on taxes, folks. Because in this NUA example, if you just left it in your 401k, you left your Apple stock in there, and you pulled the money out of the 401k just as a distribution, you're going to pay ordinary income tax rates on that. So by using this methodology that I'm showing you, you might be able to get away with no taxes on that amount other than the initial tax on whatever your cost basis is. I won't go much more into NUA because that's a topic in itself. But if you do have company stock in your 401k, you need to be thinking about this. So again, big mistakes. The biggest, not doing the planning, especially for people who just retire. Taking Social Security a little bit too early when you have large capital gains. And then if you have company stock in your 401k, not utilizing the net unrealized appreciation, or NUA, tax provisions. So if you would like free financial information, and like I say, it's worth every single penny of it, you can sign up for my newsletter right here at picketfencefinancial.com/education. You can go to our Facebook page or our YouTube page, which is just Kirk Kinder. If you sign up for our newsletter, we'll let you know every month of when we're doing these webinars online. We also have in-office seminars, and we write articles for various publications and get quoted in press, so you'll be able to keep abreast of all of that. And of course, we always finish with our lawyers telling you a little bit about our disclaimer. If you have any questions at all, I'd be happy to discuss it. You can just drop me a line at kirk@picketfencefinancial.com. Take care.